I'm Dylan Sizemore. I'm going to start the 5 pillars of success. I was already introduced by Chris. And I'm going to cover the first topic, which is, this is assigned to Kanai. I'm going to cover the first topic, which is entity selection and properly documenting your business. One of the biggest missteps that a lot of businesses can take is the first one, which is what kind of entity do I want to be? What kind of entity should I be? Am I protecting myself? Is this the way that I want to be taxed? Some of the entities are sole proprietorship, general partnership, and then you got a plethora of limited partnerships, and limited liability partnership, limited liability, limited partnerships, and we'll get into some of that a little bit later. And the limited liability company, the C corporation, and an S corporation. So what are the considerations that when you're deciding what business entity you want to choose? These are some of the considerations. One of the first ones is, hey, how many owners do I have? If I'm a sole proprietorship, I've got one owner, that's all I can have. Sole proprietorships can't operate with more than one owner. If you add another person to your business and you're running a business, then you now have a general partnership, unless you document it otherwise. So general partnerships have more than one owner. They can have unlimited amount of owners. That goes the same for limited partnerships, limited liability partnerships, and LLPs. As far as LLCs, instead of having owners, you actually have members, but the members are the owners of the company. You can have an unlimited amount of members, unless you elect to be taxed as an S corporation, which an S corporation can only have 100 shareholders or 100 owners. If in a C corporation, you have shareholders instead of owners, and they act as decision makers with their voting interest. So what we have with the next thing we'll cover is whether or not I'm protecting my assets as far as limited liability protection. Liability is a person's, it's a person or an entity's legal responsibility to a contract or any kind of wrongful act that they may do or wrongful act that may happen. And what you have is if a person commits this kind of act, then they can, you can personally go after their assets or their business if you don't have limited liability protection. Joint and several liability is a concept that happens with partners, and it's where if one partner does something wrong or enters into a contract, all the other partners can be drug into the same litigation or can be responsible for that contract or wrongful act. Vicarious liability is another interesting concept where if you have employees and they go out, they're driving down the road, they get in a car accident, and they're actually acting for your business or for your benefit, you can be liable for that as well. If you don't have limited liability protection, your personal assets are at risk. So what is limited liability protection? It basically protects your personal assets as an owner from any wrongful acts of the business or people acting on behalf of the business. And it also protects the business assets from any wrongful act of the owner. So if you have members of an LLC and one of the members goes out and does something wrong or enters into a contract of their own volition, has nothing to do with the business, they don't use the business name, if somebody wants to come after that owner, they can't necessarily just come after the assets of the LLC. So essentially you're protecting the company's assets as well. It can make it difficult to get after the interest. That's one thing that is possible, is for them to sue for the interest in the company. It's very difficult to do though. If you're a shareholder, they can take your shares. There is potential for that. But as far as getting at and then I guess once they own an interest in the company, then they could get after the assets. I like to use Isaac's box analogy. So what limited liability protection is if you put something in a box and you have the box is the limited liability protection. So you can't get into the box and take things out of it, right? And then if you have multiple businesses, so if you have 2 LLCs and you have 2 boxes and you've got things in this box and things in this box, you're not going to be able to get one out of the other. So if somebody comes after all the objects in this box, they're not going to be able to get the objects in the other box. So the entities that do not provide limited liability protection are sole proprietorships, general partnerships, and limited partnerships for general partners. And the limited partnership is it's one of those things where you have general partners and you have limited partners. Limited partners are generally passive. They have nothing to do with the management. And there's also some filing requirements with the state to actually be a limited partnership. So it's not something that you're necessarily going to have. You're not going to just have a limited partnership just because you say you want a limited partnership or you put an agreement that says, yeah, I have a limited partnership. There's actually filing requirements for that. Now, the entities that actually have limited liability protection are limited liability partnerships, the LLPs, which are limited liability limited partnerships, LLCs, limited liability companies, and corporations. There is one caveat to this. Well, there's multiple caveats, but the biggest one is piercing the corporate veil. It's something that doesn't happen often, but it's something that you should always be concerned about. And two of the biggest things that you can do that could cause, and let me first explain what piercing the corporate veil is. It's basically you have limited liability protection, but somebody, a debtor or a creditor rather, to your company decides they want to come after the assets, they can actually pierce through the limited liability protection in certain circumstances. And one of the sure ways to do that is if you misrepresent something or commit fraud, or another big one is mixing bank accounts. So if you don't keep a separate bank account for your business from your own personal assets, or you're paying bills out of a business's bank account, there's a good chance that you could stand to have piercing the corporate veil issue. The next topic would be tax liability. A lot of people, taxes are a huge deal for them. You don't want to be double taxed. C corporations are the only entity that's double taxed per se. You can elect as an LLC to be taxed as a C corporation. You can make a lot of different elections. The LLC is probably the one that can elect I think almost any of the entity selections. So they can elect to be taxed as a C corporation and then elect to be taxed as an S corporation. If it's a sole member LLC, you can elect to be a disregarded entity and the tax just flows through. And what flow-through tax is you just claim the tax on your own personal income, federal tax income statement. If you're a multi-member LLC, then you would do a partnership. You have to claim taxes as a partnership. And that's the way that an S corporation would work if you have that situation. You have different forms, but essentially you calculate everything in a partnership tax realm. So the management structure, what we're talking about here is how the business entities are managed. With sole proprietorships and general partnerships, your owners manage the business. With an LLC, you have a couple different options. You can do manager managed or you can do member managed. Manager managed is where the members basically choose in the operating agreement, which is the document that tells you how this business is going to work. They choose a manager. It can be a member, it can be I mean, they could elect anybody as a manager, and they run the day-to-day business. Member managed is generally like the members are more hands-on, they're making the decisions for the business. If you're a corporation, generally speaking, you have to have directors and you have to have officers. So that's who manages the business. As far as ownership structure, we already kind of hit on it, is with the sole proprietorship, the actual person that is the business owner, they are the business essentially. With partnerships, it's the partners, LLCs, it's members, and with corporations, it's shareholders. Statutory requirements. This is, your filings. With all your limited partnerships, you're going to have to file. You have to file for LLCs, and you have to file for C corporations. But C corporations have a unique thing where you have to have annual meetings. So that's a big thing that LLCs have the advantage over, is you can eliminate that of having to have those annual meetings. The next issue is ability to change tax structure. And essentially what that is if I'm a sole proprietorship, and Isaac uses an example of going up the ladder. It's easy to go up the ladder, it's not so easy to go down the ladder. So if I'm a sole proprietor and I want to bring somebody else on in my business, then I'm a general partnership, right? So, and I may choose to file to become one of the limited partnerships, or may choose to file to be an LLC, and at that point I begin operating as that entity, choosing the tax election either as a partnership or a C corporation, however you choose if you have multiple members. If you're a sole member, again, it's a disregarded entity and it flows through as on your personal tax return. If you move up to a C corporation or an S corporation, trying to come back down that ladder is much more difficult, because you have serious tax implications that could arise, and it's best to always consult with your accountant when you're talking about taxes on your business and how moving from one entity to another, and what effects that it's going to have. And the last big thing is just making sure that you understand, like, if a lot of business owners, and they say, hey, well, I'm going to partner with this other business and it's going to be a joint venture, but you have to be careful about whether or not it's a joint venture or a partnership, because a partnership can occur without any kind of agreement. It's just two people coming together, or two entities coming together to do business. If it's not well defined, and how the profits are split up, and how it's going to operate, which is a partnership as well, but you want to document a joint venture if you really think that you're going in a joint venture. And the reason that it can be an issue is because if it falls into the partnership realm, you could be required by the IRS to have to file as a partnership, filing your taxes as a partnership. But a joint venture would be different. And at this time, I'm going to turn it over to Isaac Hines.
So if anybody has any questions along the way, just feel free. If something Dylan was talking about or something that I'm going to be going over. The second pillar that we're going to talk about is structuring business entities and transactions to avoid unnecessary taxation. The first item on this one that we're going to talk about are 1031s. And 1031s are also commonly known as like-kind exchanges. This allows a taxpayer to reinvest the proceeds from a sale into another like-kind property without having to pay the taxes currently. So what it does is it essentially provides you with the advantage of being able to defer taxes until a future taxable event in connection with the property. Often comes up with real estate and large equipment. It can come up with things like licenses, cattle, or any other investment or business property. The one thing it does not apply to is equity interest in entities. So it doesn't apply to stock, it doesn't apply to partnership interest, it doesn't apply to membership interest and things like that. There's limited exceptions with, if you have a solely LLC that's only owned by one individual, you can actually do a 1031 with the membership interest, but it's treated as if that entity is not there. So when we do a 1031, it allows you to keep all your money on the table. You put it all back into another transaction, assuming that you can find another property to invest it in. And then at a later date, if you want to, you can pull it out by taking a loan against that property. So that can be a big tax advantage. Now, sometimes when people are in a limited liability company or they're in a partnership and they decide to sell a property, they really want to go their separate ways day 2 after the sale. Now, you can do that, and typically the best way to do that is to do some advanced structuring before the transaction. You can either distribute whatever the real estate or asset that was in the company out to the members as tenants in common, so they each own a direct interest in that property. So, for example, someone might own 50% of the property and the other person owns 50%. Then they do the like-kind exchange for their 50% interest in whatever that property is. Another option is you can do what's called a partnership division, where the partnership actually divides into 2 separate partnerships, where one is primarily owned by one individual and then the other is primarily owned by another individual. And then they go about the exchanges in the different partnerships. So that's a way to avoid having to pay the current taxes and defer it to a future event. Another concept is capital contributions to companies when you form. Capital contribution to an entity is not going to be taxable, so it allows people to invest properties in a joint or a business venture with another party. So if you start up a limited liability company, a corporation, whatever have you, you can drop your assets into it without having to realize gain. Sometimes I do run into clients that say, well, we want to sell the property to the company. And my advice is usually, talk to your accountant, but you're probably better off treating it as a capital contribution and figuring out the cash coming back to you on the backside. But that is one option. Another option to avoid that I don't have listed up here to structure a transaction has to do with real estate, to avoid a step up in your auditor's value when you buy a new piece of real estate. So when you buy a property, if you buy the real estate, the auditor is going to see the value that you paid for it when you go fill out the conveyance form. One exception that they have of reporting is if you don't actually buy the real estate, but you buy the membership interest that owns 100% of that real estate. So what we've been successful in doing is helping clients structure a transaction where they want to buy a large piece of real estate. They're going to pay a lot more than what the auditor has as the reported value. We've been very successful in helping those clients structure it so that the seller drops that property into a limited liability company and then they buy that membership interest in the limited liability company. It never shows up on the auditor's records as a taxable transfer, so they don't know about that sale of the property. And usually, and Chris, you can, have you had anybody come back and question one of those transactions after?
No.
Never. Okay, so we've had recently.
We got battery issues, plugging issues.
I asked her
Okay.
for the power cord. Yeah.
Okay.
So for instance, we recently had a client that they bought a property that was on the books for around $2 million. They bought it for $4 million. That $2 million is not going to show up for the auditors, and they're going to have tax savings as long as that stays in effect, and the auditor's probably not going to find out that was.
We had a client recently from California, and we told them about this, and they said, well, there's no way that something that good can be legal. But it is. I mean, you're not misrepresenting anything to anyone.
Right.
It's just a corporate transaction, so they were very pleased, but it's a way you can save enormous amounts of money in a real estate transaction when it's long-term on your real estate taxes.
So that'll take us to the third pillar of success. The third pillar is securing good title and planning on future use of the property. Title insurance is a one-time. Title insurance is a one-time title insurance policy that you buy that insures you against the banks against financial loss associated with the mortgage not attaching to the property or being misreported, and also the insures your title to the real estate. So when you buy title insurance, it's basically an insurance policy that you don't have to worry about day 2 someone coming in bringing a claim saying that they were really the true party that owned that property or they didn't have authority to sell or whatever else have it. have you, and then make a claim to that property. And we have had, I mean, we've had a couple of recent cases where that's happened, where we'll have people actively committing fraud. They'll sell a piece of real estate. Our client, may have bought it, but if they bought a title insurance policy, they're going to be covered by that title insurance. So they don't have a loss. The title insurance policy will either pay for a legal defense to the claim, or else they will actually pay out the policy, the value, the loss that they have on that real estate. So that's a great advantage, something to think about on if you're buying commercial or residential property. It's a one-time premium. You don't have to worry about it in the future. One of the due diligence steps that we talk about is doing a title search on the property. You're going to review the records of the clerk, the county recorder, the auditor, and you're going to determine whether or not there's covenants, restrictions, easements, liens on the property, that type of things. It lets you know what you can and can't do with properties. It really becomes, it's important with residential properties, but it's, in my opinion, very important with commercial transactions when you want to make sure that what you're buying you can use for your intended use. So if you buy a piece of property and you want to be able to put a restaurant there, there could be a restriction on that property to prevent you from doing that, and that's not too uncommon. Or there could be a restriction that says you cannot develop this portion of it, or you're limited in size of how big you can build your property. For residential, I think some of the key things that I see in my practice that come up is there'll be restrictions on people buying condos and being able to lease them out as rental property. And a lot of people will buy condos thinking, well, maybe I'll rent it to my kid while they're going to college, or maybe I'll buy it as a vacation property, whatever. There's a lot of times you're going to see restrictions in the condo documents that say that you cannot necessarily rent those out to other people, and you may buy it and find out that you can't do what you wanted to do with it. Another part of the title search is you're going to determine whether the entities selling the property are properly registered with the state. If they are not properly registered with the state, then they're not going to be actually be able to convey good title to you. So it's not uncommon for us to run into a situation where there'll be a company that missed some filing or something like that, and at the time that they're doing the transaction, you go to look at it and they're defunct with the state. But you got to get them back up and running before they're going to be able to give you clean title to that real estate. Another part of the due diligence in connection with title is survey. You get a survey to determine if there's any encroachments of the properties. Make sure you're getting what you think you're getting. Often with surveys, you also can get the easements platted to make sure that you know where the easements run. So you know if somebody has a driveway easement on the front of your property, you know if there's a utility easement that's maybe going to prevent you from putting in a patio in the back or whatever else that you might be covering up with that. Zoning permits and zoning challenges are another issue. Those are more commonly arise in connection with commercial properties. So often when you think about developing in an area where there's been a business for a long period of time, the city creeps or the township creeps to these places where they previously had a business that everybody was okay with it being there, and now you have all this other stuff around it and they don't want it there anymore. So you want to make sure whatever property you're buying has an appropriate zoning for what you're doing. And if you do have a permitted use on a property, you also want to ensure that you continue that use. So we have a client with a trailer park in a more developed area now, and the city wants to get rid of it. But they can't just come in and say, you can't do this anymore. They're allowed to do it as long as they continue to do it. Now, if they stop doing it for a period of time, that would be different. They would lose that right to be able to do that. So that's another example. We had it was a recycling or
Years ago, we had a pallet maker,
no, I'm thinking of Marty.
or recycling, oh, he had an incinerator, and he
Yeah,
had dumpsters and portalettes
Portalettes, and they wanted him out of there too.
in the middle of this urban area.
Right, in the middle of urban area. They wanted him out too, and that was
Take
another
your
one.
clients as they come.
But that's an example of if you have it, you continue the use, you're going to be able to do it. I had one recently where the guy bought what he thought was a commercial property that was zoned in residential. The use discontinued for 6 months, and then they said, you have to be residential now, you can't be commercial anymore. I haven't heard from him, but I'm hoping that worked out well for him. Easements are another item that we talk about when we start talking about title. Easements are either benefit or burden property. An easement allows you some type of rights over another person's property or encumbers your property so that there are rights against your property. For residential properties, typically we're talking about fences, utility easements, driveway easements, that type of stuff. For commercial properties, a lot of times we're talking about ingress, egress, parking, stormwater retention, slope easements, access easements, and those types of easements. Environmental issues are always a concern. With residential properties, not so much, but that being said, it's my understanding the average house that has had a building on it for over 100 years, if you did a soil sample on it, you're probably in violation of the lead level requirement on that house, just because of lead paint over the years. Doesn't come up much as an issue, but it is there. Another one for residential properties that you think about is underground tanks that are on farm properties that were used for oil. Those are often there. They're actually exempt from enforcement. If you have a tank and it happened to leak, right now they're exempt and you actually have to clean it up, but at some point, I think the popular thought is that is going to become an issue. For commercial real estate, big issues are wetlands. I mean, if you buy a piece of property with the idea that you're going to develop on it, if there's a wetland on there, it can prevent you from being able to practically do anything with that property. Another issue you run into on commercial property is contamination from a previous use. Like a lot of times in the city, there's dry cleaners that used to go out and dump their stuff in the back alleyway, and you'll find that there's contamination in connection with that type of property. You don't think about it, but historically it was there in old buildings. The American Can building in Northside, when they went to redo that, they had a remediation program that turned out not to work, and they had to get another $200,000 to do the remediation or something like that. You also want to review plans for the surrounding areas. Make sure that what you're buying in the future has what you think is going to be there. You may find that they're going to put a school across the street. That's in the plans, or maybe they're closing off your access and entry that's closest to you. And obviously those would affect your assessment of what you see as value in the property. Could actually increase it too if you like the plans that they have. The fourth pillar that we're going to talk about today is positioning your business to avoid or win fights against government regulators. So when we were talking about zoning, again, maintaining zoning is a good example. If you want to use a property for a particular use, you got to make sure that you maintain the zoning or whatever rights you have to use that property in place to avoid it terminating. Proactive compliance is another issue. So proactive compliance, by what I mean about that, is doing things ahead of time to avoid the municipality coming in and telling you what to do. From my experience, there's a lot of issues that I wouldn't consider health and safety issues that are required by the code for maintaining property. Like I think in Cincinnati, chipping paint is a violation of the code. If you have a leaky downspout, that's a violation of the code. Things like that. If they come in and they look at it, they can tell you to fix it. But I think that overall, if you're maintaining the property in a good manner, they're not going to come in and look for chip paint on your building, or they're not going to look for holes in your tuck pointing and things like that. It just becomes an issue when they're coming for other reasons, and then they see all these other things. In Cincinnati's a good example, they actually have a code in place right now called the Vacant Building Maintenance License Program, and if they find any violation on your property, they can force you to vacate the entire property and pay an annual fee until every violation is cured. So, opposed to having that happen, proactively try to maintain your properties, take care of them, and then hopefully that type of thing won't come down and won't be an issue. The other thing is, too, from a practical perspective, I think the local municipalities and authorities are interested in seeing properties occupied and redeveloped. And I think if they see you working on your property and trying to do the right thing, I think in general, my experience is that they're going to be more flexible in enforcing the code. I mean, I don't think that's always the case if they have other reasons to be upset with you, but I think in general, if they see you're doing the right thing, they're gonna be much more lenient than if they have to come to you and tell you to do things. That takes us to the fifth pillar of success, which is estate planning. So estate planning, overall, you just want to make sure that that estate plan is in place and that you have a plan as to how your assets are going to go, who's going to step in to take control, all that type of stuff. Part of what's not on here that really is appropriate for businesses is worrying about buy-sells, worrying about financing, payout schedules, and all that type of stuff. I'm dealing with a situation right now where we have 3 doctors and they couldn't agree on a buy-sell agreement, and while one of them was trying to get out, another one passed away, which really threw a monkey wrench in their plan, because now they have to buy out 2 doctors and they were only planning on buying out 1. Now, if they, part of that planning, if they had insurance to help cover that and everything else, that would have been great. But we're dealing with it now, trying to figure out how to buy out 2 people instead of 1, and not really having the funds to do that. But we can go through some of these documents. The will is a document that's admitted to probate. That appoints your executor. If you have small children, then you're also going to appoint a guardian to decide to take care of your children. The will tells your executor how you want your assets to go, gives them authority to sell your assets, to do whatever they need to do to get your estate to where it has to go. So they have the power to pay debts, things like that. And then if you have a trust, which is a common structure for people with children, I'm going to jump down to the estate taxes. So previously, people were worried about paying estate taxes. In Ohio, that's not really a realistic concern anymore unless your net worth is over $5 million. And unfortunately, I'm not in that situation, and most of my clients are not. So estate taxes are no longer the driving vehicle for estate planning, from my experience. There are certain individuals that it is, and it's a big tax if it's applicable, but for a majority of the people out there, it's not going to be an issue. So that brings us to why you would want a trust if we're not talking about estate taxes anymore. Well, there's other reasons to have trust, and one is to act as a conduit of all your assets, to make sure that there's something there to collect everything, pay out everything, and then make sure it's divided how you want it to be divided. The trust allows that in a private manner. It's not something that's going to be disclosed to the probate court unless there's a suit regarding it. So generally, it's a private means to act as a conduit to make things happen for you. Also, the trust can act as a standby for you while you're living and you're unable to handle your own financial affairs. The trust can hold those assets for you and distribute them to you. The trustee can distribute them to you and divide them up for your benefit during your life or however else you want. The trusts are also what I typically, with younger couples, maybe they don't have a lot of assets and they're not worried about how it's divided, but they're worried about their kids being taken care of one way or another. The trust, either you call it a standby trust or educational trust, there's a lot of buzz phrases for it, but it essentially acts as a standby to get everything into one pot so that it can be used to distribute to the kids however you want it to while they're minors, and at some point they usually have the right to come and say, hey, I want my share, I'm old enough, and whatever structure, you do that. A lot of estate planning anymore has to do with arranging transfers so they avoid probate, but they don't fall in the trust category. We're talking about doing things like joint survivorship. One thing, this is a little tip that I come across as frequently, but it happened the other day. If you have older parents and you think that their property, that they own it in their joint tenancy, you really want to check their deeds, because it's really frequently not in joint tenancy. Back, I would say like 25 years ago, that wasn't the common practice to automatically title it in joint tenancy. I think it's more. So
what happens if one of them dies when it's
you have to
not?
probate it. So we have to probate a half interest in a house.
Yeah. So what Isaac's saying is there's 2 ways that couples typically can own real estate. Almost always, it's joint with right of survivorship, and when one of the couple dies, title by law automatically passes to the other. There's nothing that's necessary to do that. But the other way to own it is what they call with tenants in common. And in that circumstance, if the deed's not clear, if it's tenants in common, then you have to go through the probate process to transfer that title, which is just expensive and time.
Right, and in this, for example, in this particular situation, the only asset that we're gonna have go through probate is the house. And probably if the house wasn't there, there would have been some medical bills that may have not have got paid. But since the house is going through probate, they're gonna know it's there and they're gonna make them pay every cent of the medical bills. So it's unfortunate, but that's just a tip. If you have older parents, you may wanna look at that with whoever their legal advisor is to make sure that it's titled how you think it is. Because just because both their
Very
names.
inexpensive to fix that beforehand,
Right.
just a new deed,
Right.
a couple $100 and you fix that issue.
Right. So the other thing is you can do what's called a transfer on death designation on real estate now. This is within the last 10 years. You can file an affidavit that says who you want your property to go to and what shares if you were to pass away. The transfer on death designation is not effective during your life. It only is effective if you were to pass away and the designation stays in place. If you go to refinance it, the bank shouldn't tell you to take it off because it should be treated as if it doesn't really exist. If you go to sell it, you don't have to file an affidavit of trust, which you used to have to do when you transferred your property into trust, so that's a great option. Gifts, any individual can give, I haven't checked this year, I'm not sure if it raised, but it's approximately $14,000 to another individual, gift tax free, every year. It's the annual exclusion that you can do, so as many children, as many parents, if you have 2 parents, each can do the same gift to your children to get assets outside of your estate if that's something that you choose to do. The only problem with that, a lot of times people want to keep strings on the money that they give, and it gets a little more complicated if you want to prevent the people that you're giving it to from actually accessing what you're giving it to, but it's possible. Payable on death and transfer on death are similar to the affidavit of the transfer on death affidavit. So accounts are payable on death. You can have a payable on death designation on your bank account, your finance accounts, and things like that. And then transfer on death. And then you have insurance policies. You want to make sure that your insurance policies have beneficiaries named and the beneficiaries are who you want them to be. Those are going to go by contract outside of probate. So I think I have gone through everything. Did anybody have any questions about any of the topics that we've talked about? Any clarifications today? Keep everybody awake?
Great job, appreciate you guys.
Okay. Well, thank you.